What's up, you guys? Welcome back to Business Buzz, where we focus on business, entrepreneurship, and investing. Today, we're going to be talking about how taxes work on stock gains. Make sure you guys go down and leave a like below. Making money in the stock market is a great way to build wealth. And if you're here watching this video, you're probably already dabbling in it, which is a great sign. Something that isn't talked about quite enough, however, is how taxes work on your stocks. This is why it's very important to understand how much you should expect to pay on your taxes on your stock profits. First of all, it's important to understand that taxes only apply to money made in the stock market, aka your net profit. In case you don't know what net profit is, it's your total losses subtracted from your total gains through sale of stock that year. In fact, if you lose money in the stock market, if your net profit is negative, then you can actually deduct some of that money from your income tax. Actually, you can deduct up to $3,000. Profits you make in the stock market are known as capital gains. Capital gains is an umbrella term that applies to a multitude of appreciating assets such as bonds and some types of real estate. These capital gains are of course necessary to be claimed on your taxes and are taxed based on your income, just like your income tax. Keep in mind that you're only going to be taxed for stock that you sold that year. Let's say you've owned a bunch of shares in a company for multiple years and you still haven't sold it. You aren't going to need to pay taxes on that. Only until you sell stock are you going to need to pay taxes. Capital gains are also taxed differently depending on if it's a short-term or a long-term gain. A short-term gain is characterized as a sale of stock within 1 year of its purchase. A long-term gain is characterized by any stock held for over a year. Short-term capital gains are taxed exactly as your regular income tax. You should already know what percentage you lie in, whether that be 10, 12, 22, 24, so on and so forth. However, you got to keep into account that any money that you make in the stock market also applies to your income, so that can actually move you up in the tax brackets. Long-term gains, while also based on your income, are taxed a little differently. Here's a quick rundown if you're a single filer. If you're making up to $40,000 a year on your income, you literally pay 0% on long-term gains. If you're making anywhere between $40,000 and $434,000 in your income, you're going to be paying about 15% on those gains. If you're making anywhere above $434,000 on your income, you're going to be paying about 20% on your long-term gains. Of course, if you're not a single filer and you're married, or you're married but filing separately, or all sorts of things, check the link in the description to find exactly what you'll be paying on short and long-term gains. You've probably already picked up on the fact that this is a big incentive to be a long-term investor, because you're paying a lot less in taxes. You may still be wondering how dividends are taxed. If you don't know what dividends are, they're basically what companies pay you in cash for each sale of stock you own. Not every stock is a dividend stock, but famous ones like Coca-Cola are. There are two kinds of dividends: ordinary dividends and qualified dividends. Ordinary dividends are taxed like your normal short-term stocks, aka your normal income taxes. Ordinary dividends make up the vast majority of dividends from companies. Qualified dividends, which are much less common, are taxed just like your long-term gains at 0, 15%, and 20%. You're going to have to do your own research to find out whether the company you're invested in pays out ordinary dividends or qualified dividends, as of course they will be taxed differently. Let's say on long-term investments, you gain $15,000 on a sale of stock and you lose $5,000 on the sale of another. What's your profit? Obviously, it's $10,000. For this example, let's say your yearly income is $60,000. That would put you in the long-term tax bracket of 15%. Because of this, you're going to be taxed $1,500 that will be paid to Uncle Sam, and your total profits for that year will be $8,500. So now you'll know about how much you'll be paying for your stock gains throughout the year. However, if you want to learn more about how to actually pay these taxes, make sure you leave a comment down below if you want to see a video on that. Thank you guys for watching this video. If you took something of value, make sure you definitely go down and subscribe. I know this can get kind of complicated, but there's good resources out there like Investopedia and sites like that you should definitely check out if you want to learn more and retain more information. Anyway, thank you guys so much for watching Business Buzz, and I'll see you next time.